Hello and welcome, financial management students. Steve here. Nice to be back with you. In this video, we will debrief the recent mock exam that you attempted, and congratulations for doing the mock. It's going to get you closer to a pass on your upcoming exam. If you have not tried the mock, pause this video, jump into the practice platform and give it a try. You'll get much more out of the video. All right, we're going to do the most difficult questions from Section A. I'll take you through the most difficult part of Section B, and then we will do the Section C questions together. All right, let's jump in and get started. Let's begin our debrief and imagine we are beginning the exam. Team, I press next. I'm in Section A. And I've got to fill in the blank question. You know, if you decided, I'm going to flag this one and go get easier marks first, I would completely respect that decision. You know, there's a lot of information here to process. It's fill in the blank, so it's a risky question. But, you know, we'll try it now because I'm going to take you through the most difficult ones. So we always begin a Section A question reading here. What is the minimum price per share? Got to read really carefully. Okay, that the owners would accept for the company. So, I want to sell my company. How much would I accept? That's valuation. So we got to get our head in the game and understand what area of the syllabus is being tested. And for valuation, you have three things, right? We've got the net realizable value approach. We've got the asset-based approach, or dividend-based approach, or earnings-based approach, EPS. What do I see right here? I see assets, I see NRV. Keywords jumping out at me. So I think this is going to be an NRV, net realizable value type of question. But let's jump in and check it out. So the owners wish to dispose of their entire investment in the company. They have issued share capital, 1 million of 50-cent nominal shares. I told you that many times. Whenever you see this, the 50-cent nominal value, you know with all certainty you're going to need the number of shares off of that. Every time they give you the 50-cent nominal value, you need the number of shares for something, so keep that tip in your back pocket. Owners have made the following valuations of the assets and the liabilities. Well, we know that the net realizable value will be assets minus liabilities, everything adjusted for market price or changes in the event of a liquidation. So, do we have some assets? Yes, we do. 30 plus 18, right? That would be my total assets. Minus some liabilities. We could just simplify the math. I don't need to group it as assets and liabilities. So it's just going to be what? 30 plus 18 minus 12 minus 10, assets minus liabilities. The NRV of the assets exceeds the book value by 4, so we add a 4. And the current assets include 2 million that will be irrecoverable if we liquidate. So I subtract the 2, and what do I get? $28. I put the 28 in here, and I feel very confident, but then that music plays. Wonk, 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 wonk. I did not read carefully. Guys, I did not read carefully. So I got lulled into a false sense of security by going too fast. What do we need to do? Divide by the number of shares. This is all million. So now we need to go like this. 1 million divided by 0.5 equals 2 million shares. Okay, so 28 million divided by 2 million equals $14 per share. Okay, so there we go. $14 is the answer. Moving on to the next tricky question here, which would be number 5. And we read the requirement, and we see, in relation to the finished goods inventory and assuming a 360-day year. Guys, whenever they give you the number of days, you know something is coming at you, and that's going to be one of the days workings, inventory days, receivable days, right, or payable days. So that's a clue. We know we have one of those calculations coming at us. How much finance will be needed from the overdraft? Well, remember this. If we have a balance sheet, inventory is an asset, overdraft is an asset. So if this goes up, then something over here, all things being equal, would go up as well. What's going on there? Now, what's the trick about this question? This business about the permanent and the fluctuating current assets. So they got sales of 2,000 per year, 200 million per year, and a profit margin of 40. So we know the cost of sales then, don't we? Inventory holding period for finished goods varies through the years. Look at this. We can visualize this. If this is dollars, this is time. The permanent would be the lowest level that we have in the year. Then sometimes we have a lot of inventory sitting around, and then sometimes we have less inventory, right, based on our business cycle. So the maximum would be here. The minimum would be here. The difference would be the fluctuating. So they tell us here, look at this, maximum 120, minimum 90. You guys, that's what's going on there. So what's the difference between 20 and 90? That's the part that fluctuates. Okay, so that's now that we've unraveled that mystery, we know the difference then between those is 30, and that's the fluctuating part. Okay, all purchases and sales are made on a cash basis. No inventory or WIP, no raw materials or WIP is carried. So these are simplifying assumptions. So look at this. If we know cost of sales would be, the profit margin is 40, the cost of sales are going to be 60%. So that would be 60% multiplied by sales equals 120. Okay, so now if we use the inventory days formula, we could work backwards, and we could say X over 120 multiplied by 360 is equal to 30 days. Okay, so the difference there, or the unknown, that would be my inventory. And the solution is 10. X equals 10, so our inventory would be 10 million. Answer is A for question number 5. Another tricky one. Moving on to number 6, a theoretical one, but I found this one a tricky theoretical one. In relation to an irredeemable security paying a fixed rate of interest. So we have some irredeemable bond. And Let's visualize that. An irredeemable security would have a market price, and that would be here. The investor would receive some interest payment, and then that would be discounted to that cost of debt. I'm going to put an R for there, okay? Just rate. Guys, this is the present value formula of a perpetuity, a cash flow that goes on forever. Okay. Let's put some numbers there to visualize it. Let's say this instrument pays 20 cents a year. Let's say the market value is 200 cents or $2, right? So now we know the implicit rate, interest rate on this would be what? 10%, 0.10. If something becomes riskier, that means the cash flows become more volatile or less certain. So I'm going to pay less money for uncertain cash flows than I would for certain cash flows. So we would pay less. If that goes down, then this would have to go up, the rate. And that's the relationship between the price and the rate. So as risk goes up, investors would want to be compensated for a higher return. And the way they would be paying less money for those cash flows. So the answer then, as risk rises, the market value will fall to ensure that investors receive an increased yield, right? Increased return here. So that's what's happening. If the cash flows become riskier, investors will pay less to be compensated for a higher return, which would be there. So that's the thinking here for question 6. Moving on to question 7, we've got another tricky theory question here. Let's unpack it together. Popco is switching from using mostly long-term fixed rate finance, so long-term finance to fund its working capital, to using mainly short-term variable rate finance. So if we visualize that, we've got our non-current assets plus our investment in working capital, right, which is CA minus CL. That's equal to our equity plus our debt. That's long-term finance on this side, right? Long-term. So they're currently using long-term fixed rate finance, so maybe a long-term a bond with a fixed coupon rate there is how they funded that, and they're going to switch over to this, maybe some current liabilities, short-term variable rate. So that could be a short-term loan, or that could be, an overdraft. Now, all things being equal, the long-term debt will be more expensive than the short-term debt. Okay? So if you want me to be denied of my cash flows for a longer period because it's tied up in a loan to you, I will want higher returns for increased risk. So we're switching over to here, to current liabilities. Overcapitalization risk, that one goes out, because if you remember, undercapitalization is overtrading. That means we're funding our growth with more short-term finance. Overcapitalization is the opposite. That would be transferring the short-term finance to the long-term. So that one goes out. Finance costs will increase. That one goes out because the short-term is cheaper. Now, interest rate risk will decrease. I guess that means our exposure to the variability of interest rates. But no, we're switching now to variable rate. That goes out. So by elimination, refinancing risk will increase. That's right, because when we're short-term, debt needs to be refunded. So now there's a risk that the interest rate could increase when we need to refinance. So the best answer is B. Guys, the exam technique there is to really go slowly through all of them. Make sure you have eliminated at least 2 of them before you select a correct one, okay? If you're in a big rush and you just look for the right answer, probably not going to work out. You might make a silly mistake and miss an important keyword. Okay, so there we have question 7. Team, moving on. We are now at question 9. What is the theoretical value of the company? We're back at valuation with question 9. Guys, there are a lot of valuation questions in section A usually, because if you remember, valuation is only examined in A and B. So there might be a disproportionate amount of questions on this topic in A, okay, because it doesn't get tested in C. So just be ready. Do a good job on your valuation prep. So let's have a read and see what we've got. We've got after-tax operating cash flows of $2 million, which are expected to continue into perpetuity. Ladies and gentlemen, we need the present value of a perpetuity formula. Again, present value of a perpetuity. That's going to be equal to the annual cash flow discounted by some rate. If they want the value, that would be here, right? If they want the cost of equity, that would be a percentage. That would be over there. So all we got to do is find those after-tax cash flows, and those are $2 million. So if we are after tax here, we want to be after tax with our cost of capital. So we got a before tax cost of debt. We've got a cost of equity. We've got a cost of debt. But guys, we want the value of the company. So we don't want either of those. What we want is a weighted average cost of capital, because we're partially equity, partially debt. And they gave me after-tax WACC, which is 0.08. So guys, x is equal to 2 divided by 0.8. Sorry, that's not 0.8, that's 0.08. 0.08, 8%, not 80%. So that comes to x is equal to 25 million. Guys, is that number in the list? Yes, it is. Answer is D. So there we go. That's question 9. Hello, team. Moving on to question 11, the next tricky question in the set. And again, valuation, convertible loan note. Oof. Okay, what are we going to do here? Got to remember a couple of things. When we want market value, we ignore the tax shield because the investor gets the full amount, right? So we want the full amount. We want pre-tax things, not post-tax. If we were looking for the cost of debt, then we would use post-tax things, because it's the company issuing the debt that gets the tax shield. The investor gets the full amount. So guys, market value will simply be the present value of the cash flows. And we do that with the NPV concept. So guys, a present value is an NPV. So to get an NPV, we need 3 things. We need some years. We need some cash flows, and we need a cost of equity. Okay. Cash flows, we need the annual cash flows that recur. We also need the terminal value. Okay. So this helps me find the information faster. So let's have a look here. Lane has 3% convertible loan notes. The 3% is the coupon, the interest rate, redeemable in 5 years. So guys, we got the years, which is 5, at their nominal value, which is $100 per loan note. So they get $100 after 5 years. 3% of 100, that would be $3 interest every year. Alternatively, each loan note can be converted in 5 years into 25 shares. Current value is 3.6, and we expect the share price to grow at 5% per year. So now all we have to do, convertible bond. Will the bondholders take the money and run, or will they take the shares? How many shares do they get? It said they get how many? 25 shares. What are they going to do? Well, we've got to find the value of those 25 shares. So all we have to do is this. 25 shares multiplied by the current value, 3.60, multiplied by the growth, 1.05. But that's going to happen for 5 more years. So we got to put that to the power of 5 to show the compounding. And that comes to 114.87. Okay? So guys, now we understand the bondholders could get $100 or shares worth 114.87. A rational investor would go for the higher value, terminal value. So now we have everything we need for our NPV calculation. So what I'm going to do, I'm going to go over to the spreadsheet. I'm going to do something unconventional. I'm going to jot these numbers down on scratch paper. Then I'm going to go over to section C and borrow the spreadsheet. So I've got 5 years. 1, 2, 3, 4, 5, right? Imagine this is in a spreadsheet. And we got some rows, right? A, B, C, D. So I'm going to plug 3, 3, 3, 3, 3. This one is the cash flow row. But at the end, we're going to get the $3 plus that 114.37. Okay, so that's going to give me. Then in that last year, we're going to get the $3 plus the 114.87, right, which would be the 117.87. So you're going to plug those numbers into your spreadsheet. Then you're going to go like this, equals NPV. Open the bracket. Let's grab that before tax cost of debt right here. Remember, we want pre-tax things. So we want that pre-tax cost of debt. So that discount rate is 0.10. We put that in, and then we do a comma. And now we're going to grab the range of cells in the spreadsheet, right? Just grab that, and that's going to give me the range right here. Plug that in, and then that's going to return the solution, which is 82.71 with some rounding. Because whenever we use the spreadsheet versus the discount factor table, it's going to be slightly different. So do we have a correct answer here? Yes, we do. 82.71. So there we have it. Question 11, another valuation question. As I said, be ready for valuation. Moving on. I see interest rates, inflation rates, spot rates. So I know we're here in the foreign exchange rate risk section of the syllabus. And what are they? Let's read to see what's going on here. country X's nominal interest rate should be 7.06 for the year. The future spot rate after 1 year should be 1.45 dinar to the dollar. Real interest rate should be higher than that of country Y. Guys, let's recap what's happening here. So we got to identify home currency, foreign currency, or base and counter. Let's read. Country X uses the dollar. Country Y uses the dinar. So let's assume now dollar is home currency. So counter currency equals peso. Base currency equals dollar. Country X's expected inflation is 5% versus 2% in country Y. So guys, inflation rates go with purchasing power parity and help us predict a spot rate in 1 year's time. So if we remember the formula, S1 equals S0 multiplied by 1 plus HB, 1 plus HC, H being inflation. Okay? So we also have interest about nominal rates. They tell us the nominal interest rate is 4%. If you remember, real multiplied by 1 plus general equals nominal. Okay? Real without inflation and nominal including inflation. And now we got a current spot rate of 1.5 per $1. That again tells me that the dollar should be in the base. So now we do this. S1 is equal to 1.5 over 1 plus, well, what is the inflation in the home currency country? 0.5, 1.05 over 1.02. Tricky question here, guys. I'd probably flag this and come back to it. It's like 3 questions packaged into 1 question. Very risky, very difficult. Now that we have everything set up, let's unpack these statements. The nominal interest rate should be 7.06 per year. That's country X, the home country. Let's now unpack this last part, the 4-way equivalence model. If you remember, we can use our interest rate parity. That says that it's the change in interest rates that a bank uses to calculate their forward rate. So F0. And down here in the bottom, we're at S0. Okay. And with the purchasing power parity, we can use inflation rates then. One basket of goods should have an equal value in any country. So we can use inflation rates then to forecast a spot rate in 1 year's time, right? We're down here at S0 also. Okay. Now, there's a link then between here and here. The international fishery effect says that the real interest rate, right, should be constant between countries that have the same risk. So the only difference between interest rates should be inflation. So that ties together inflation and interest rates. So 4-way equivalency says then that the interest rate parity should also be a predictor of the spot rate, the S1. Okay? So that's 4-way equivalence, that they are linked. Right? And that's interest rates here as well. Okay? Linking the forward and the spot. So let's unpack this now, and we can do the easy ones first. The country X's real interest rate should be higher than that of country Y. No, four-way equivalence says that real interest rates are constant. It's nominal interest rates that are different, and that the difference in nominal rates is due to the difference in inflation. So guys, this one is false. Now here, if we do the math, we got it set up right here. We do the math here. S1. Okay, that is true. The result of our equation here is this one. Okay, 145.71. Put that in your calculator. That one is true. Now, last but not least, country X's nominal interest rate should be 7.06 per year. This one is the tricky one. Let's unpack that. We've got the two countries. We've got country X and we have country Y. Y has a nominal interest rate of 4%. The real rates should be the same. The nominal rate would be after inflation. Okay, and now we have inflation rates. X has higher inflation. What is their inflation? Their inflation is 5%. And Y has inflation of what? 2%. So guys, the nominal interest rate in country X should be higher, right? Because we have higher inflation there. So I'm going to go like this. 1.04 multiplied by the difference in the inflation rate. So that would be 1.05 over 1.02. And that returns 1.0706. So guys, if we take the 1 off of that, then it's going to be 7.06%. So according to the international Fisher effect, the interest rate then should be 7.06% in country X. So that one is true. True, true, false. Guys, that's a tricky question there. If you decided to just guess on this one, I would respect that decision. There would be other things to do in this exam that are easier. Moving on to the next one, question 14. This one is doable. We always read this first, return on capital employed. Return on capital employed, you remember, would be the profit before interest and tax, or operating profit, divided by capital employed, which is debt, long-term debt plus equity. Or capital employed, it could be like this. Non-current assets plus current assets minus current liabilities, okay, equals equity plus non-current liabilities. Current liabilities are over here, right? But if we take it off this side, we take it off of this side. So guys, that's capital employed. Equity plus non-current liabilities. Now, this is one of the tricks in a capital employed type of, when you need capital employed. They could give it to you on a silver platter when they just say equity and non-current liabilities are this, or they could give it to you in a puzzle format where they give you these figures and you need to calculate it. Let's look. Do we have an operating profit? Whoa, right there on a silver platter. Okay. Do we have any equity? Do we have any non-current liabilities? Guys, I'm wondering if this is a trap. I feel like I'm getting tricked. But guys, there's nothing else. So I've given you a rather easy one now. Notice where the placement of this question, number 14. It's very important in this exam, you go through all of the questions first, and you want to scoop up 4 or 5 easy ones. Then you go back through and you do the more difficult ones. Don't take them sequentially, or you will run out of time. Okay? So guys, do we have debt plus equity? That looks to me like 12,500. do we have operating profit? 2,500. So 1 over the other. That gives me 20%. That is the answer. Okay. 0.2. Not so bad. Question 14. Let us now move on to question 15, the last of the tricky ones. And now, guys, this is business finance, theoretical X rights, share price. Okay, I think this comes up in every exam. They love it in business finance. So if we can quickly review this. To find the theoretical X right per existing share, we're going to go like this. We got to get the number of shares, the value per share, and then a total. Okay, this is our template. We got 3 columns. Then we need 3 rows. We need current. Then I need TERP. Then I need the rights issue price. And then down here we have TERP, theoretical X rights share price. So guys, we got a 3x3 table. And let's read. They have a 5 million of 0.5 cent nominal value shares. Whenever that's there, you know we need a number of shares. So 5 divided by 0.5 equals 10 million shares. It's going to go right there. 10, right? Current number of shares. The current share price is 8. Okay? So now I go 10 times 8 is 80. Current market capitalization of the company. Now, 1 for 4. So if I have 4 of these, I get 1. So guys, if I have 10 of them, I get 2.5. Right, the ratio is 4 to 1. For every 4 shares, I have a right to buy 1 more at 6. So now we can go 2.5 times 6, 15. Now if we do the math, we got 12.5, we got 95, and the unknown right here would be the theoretical X rights share price. And we get 7.6, okay? Don't put that answer in there. That's the theoretical X rights share price, but we want it the value of a right now. So now the value of a right, that's going to be the TERP, which is 7.6. Right? So after the rights issue, the price will settle at 7.6. Rights issue price, IP, rights issue price is 6. So that would be the value of the right to buy the shares. That looks to me like a 1.6. Now, how many shares do we need to buy that? We need 4, right? So we divide by 4. And that's going to be equal to 0.4, 40 cents, okay? So that would be the value of the right per existing share. Now I'm going to give you the trick that they don't give you in any books. We can also simply find it very quickly by going there, okay? So the difference between this one and this one is the value of the right, and then the difference between the 8 and the 7.6 is the value of a right per existing share. Okay. So there you go. Question 15, not too bad, pretty straightforward. I forgot to write the answer in there. That would be 0.4. Okay, 0.4 is the correct answer. Guys, there you have it. I took you through what I felt were the were the most difficult questions there, maybe except for that return on capital employed. If you have any questions about the other ones, hit me up in our chat window and I can help you out on any of the questions that I might not have done here. Okay, let's now move to section B. Okay, team, let us switch now to section B. And I'm going to take you through the last scenario, the question of ring co. And we've got our little scenario here, quite easy to digest. And I see a dividend per share table. Whenever we see this, 100%, we need some dividend growth off of this. 100%. And they want the dividend growth model. So we need to deploy the formula. And we know that P0 will be equal to D1 over RE minus G. So I need three variables to do this. We need a D0, we need a G, and we need a cost of equity. Do we have any of that here in our story? I read the story. Right now we've got a nominal value of 0.25. So I think the number of shares is coming at me. So I think the number of shares is coming at me in one of these questions. So let's have a look. We got the nominal value. They're traded on an efficient capital market, right? So that means the price reacts quickly to new information. It's difficult to trade on public information because the share price already reflects the past and all public information. Just paid a divvy. So now we're in ex-div terms, 0.45. That's the dividend there. We've also got a loan note. And we've got a cost of equity of 10% and a before-tax cost of debt of 4% and a tax rate. We could get that to after-tax quite easily if we needed it. So let's plug in the numbers that we have. D0, 0.45. Cost of equity, 0.10. Now we just need the growth off of those. So I'm going to do this. 0.37 multiplied by 1 plus x. That would be the growth rate to the power of 1, 2, 3, 4 equals 0.45. Right? So we're estimating the growth rate off of the increase in those dividends. So the last thing to do is to solve for x. So I'm going to go like this. 45. I can just drop the decimal places. It doesn't matter. 45 over 37. And that got compounded 4 times. So we got to get the fourth root like that. Minus 1. If we do the math, we get the growth rate of 5%. X equals this, x equals 0.05. So now we got a growth, 0.05. With all of this info, we can now plug this into our formula. And D0, 0.45 multiplied by 1.05, that's growing it into 1 year into the future over 0.10 minus 0.05. So guys, we do the math and we get 9.45 9.45. So, a busy question, but straightforward. Dividend growth, you got to know it. It comes up in every exam. Let's go to the next one. Now we want a market value of each loan note. So the market value of the loan note, that is going to be the NPV. So the NPV is a dollar amount, and we need a couple of things. I need the years, I need the interest payment, and then I need the final redemption value. Put RV for redemption value. So let us read the story. And nominal value, look at this. $100 per loan note, interest rate of 6%. So you get $6 every year if you have invested in this bond. Redeemable in 7 years' time. And the redemption value redeemed at their nominal value of $100. So redeemed at $100. Okay. So now, last thing I need is a pre-tax cost of debt. And do they give it to me? 4% right there, 0.04. So once again, I'm going to go into a spreadsheet. Okay? I'm going to take number of years. We can do it this way this time, right? And we can go 1, 2, 3, 4, 5, 6, 7. I'm in the spreadsheet here, right? So that would be my row, column number 1. Then I could do my cash flows. And I'm going to get how much every year? 6, 6, 6, 6, 6, 6. Here I get 106. Okay, get 106. And now, with this, I'm going to go into the next cell, maybe right over here, and I'm going to go equals NPV. Open up a bracket. The first argument is the rate, so we put a 0.04. Second argument would be the cash flows. So I grab that range, whatever it is, right? You just grab it, drag it down, and that's going to go in here, whatever range we grabbed. And the result is going to be close to the 112.01. Might be slightly different because we are using the spreadsheet function much faster than digging around in the help window and trying to find those discount rate tables. Just do it in the spreadsheet, right? So you write down those numbers, and then you just go over to section C and you borrow the spreadsheet. Okay. So there we have it, the second one. Moving on to the next one, we have an easy theory one. The finance director has been advised to calculate the net asset value of the company. Quite a simple little request. We have no complications here in our story. So guys, net assets. Assets equals equity plus liabilities, or assets minus liabilities equals equity. Net assets, total assets minus total liabilities is equal to equity, okay? Or the value of the company. And which one is correct? Non-current assets plus current assets, that's going to be total assets minus total liabilities. C is correct for 23. Remember the exam technique. I'm taking you through this sequentially to limit the jumping around. But in the real exam, I would expect you to cruise through these 5 questions and do the easiest one first. Okay? Let's go to the next one. Another theory question, and sometimes they just dumped generic theory questions at the end. And let's see. First statement, earnings yield. Guys, the earnings yield is the inverse of the PE ratio. So if we had price over earnings of 10 times, we multiply the earnings by the PE ratio to get the price. But guys, the earnings yield ratio is just the inverse. So it would be earnings over price. Then let's just say that would be equal to 0.10. So now we would divide to get the price. We wouldn't multiply. So if we had the earnings, we divide by that to get the P. Okay, so this one is wrong. The equity market value is the number of shares multiplied by the share price plus the market value of the debt. Nope, we don't need that. Market value of equity is just the number of shares times the market price of one share. That price should indicate the risk of having that debt. PE ratio, that's just a redo of this one. The PE ratio divides earnings by PE ratio to get the price. Nope, we multiply earnings by the PE ratio. So we said this one is wrong, this one is wrong, this one is wrong. So the dividend valuation model, divi growth model, makes the unreasonable assumption that average dividend growth is constant. That is correct. We cannot, that's an overly simplistic assumption that the dividend growth will remain constant into the future. Okay, so C is the best answer here. Now, the last one, and we get another theory one. We get capital market efficiency, and examining team loves this. Expect to see something here. If you remember, we have our 4 types of efficiency. We have completely inefficient. We have weak form. We have semi-strong. And then we have strong. Okay? Remember, strong form is the theoretical view of market efficiency, where the share price will reflect all information, public and private. So if the directors make a decision in private and they don't tell anybody, the share price would still go up. Let's read the first statement. Insider information cannot be used to make abnormal gains in a strong form. That is correct. Strong form assumes that the share price already reflects private info. So the share price already reflects that. You can't make abnormal gains. Correct. In a weak form is where the share price, where we believe that the share price reflects past information, but it reacts slowly to new information. So in a weak form efficient capital market, Ring's share price reacts to new information the day after it is announced. This one is incorrect because the answer here is too specific. The day after. No, there's no rule about the exact duration or timing when the share price moves. It's just that it reacts slowly, not instantly. So we got one correct. We got one incorrect. Now, Ring's share price reacts quickly and accurately to new information released in a semi-strong. That one's correct. So when Apple Computer announces that their earnings are better than forecast, the share price moves immediately due to, high frequency trading and computerized trading with algorithms, etc. So we like this one. That one is true. True, false, true. So ladies and gentlemen, there you have a sample of a Section B 5-question mini scenario. If you have any other questions about that, hit me up in the chat group and I can answer your questions directly in the chat. Let's now move to Section C. Team, we're now in Section C, the constructed response questions. Let's tackle the first one called NESUD. And we see here, evaluate whether NESUD should accept the early settlement discount offered by the supplier. Well, we're going to use our standard approach. We're going to do cost-benefit analysis. One heading for costs, one heading for benefits. Now, if we pay early, we're going to get a discount. But if we pay early, then that means we're going to reduce our trade payables. All things being equal, if we reduce our trade payables and we have no cash, that means we would offset that by increasing our overdraft. So the cost might be increased overdraft interest. So I always get started by thinking about a template. Then we can do net for the difference. And let's make sure we give a comment here. Okay? Therefore, there's usually a mark for commenting. So let's have a look. We have credit sales, 45 million, and our current payable days are 60 days. Let's make a note of that. So we're currently paying at 60 days. Suppliers offered the company an early settlement discount of 0.5% for payment within 30 days. So guys, if we drop it to proposed days, 30. Okay, they want us to pay earlier. And if we do that, we will get a discount, 0.005, 0.5%. Admin costs will be increased by $500 per year. So we do have an additional cost. Let me grab all of this. Loving the spreadsheet. We can just do things on the fly, cut it, paste it down. Okay, there we are. And admin costs, let's plug that right in. It's going to go up $500 a year. And we buy components worth $1.5 million per year from this supplier. So guys, the discount we'll receive would be equal to 1.5. We'll do everything in dollars here because we have that $500 admin cost. I'll multiply this by this right here, the discount. Okay, 750. I'm going to come back here and put this as a negative because it's a cost. And we have one more thing to look at. Do we have an overdraft interest rate? 4%, right? 4%. So if we pay our suppliers earlier, then that means our overdraft is going to increase. So the difference in days is 30, right? So I'm going to move this discount down a tiny bit. Let's see if it breaks our formula. It does. Equals multiplied by this. And we're better. So guys, now we have to get the difference in monetary terms. And to do that, we'll use that payable days formula. So I'm going to go like this. X over purchases, 15000, let's do that right, multiplied by 360 is equal to the number of days, 30, right? We're going to get a 30-day savings. So I always set that up first. That helps me visualize the formula. So it's going to be 30 divided by that, multiplied by that. So that will be equal to 30 over 360 multiplied by 1500, 3 more zeros, and we get a nice round number. I'm liking that nice round number. That gives me confidence that we're on track. The examining team, they worked backwards from round numbers. So I'm liking that. And now, interest rate. Savings in I for interest. And what's the interest rate? 4%. So equals this one multiplied by 0.04, right? That shows me the interest, and I get 5,000, excuse me. Okay. So look at that. We plug the admin costs right in. Discount received is the purchases multiplied by the discount. Now the overdraft is going to go up by this amount. So let's do the net. That's equal to the sum here. And we've got a 2,000 positive. So therefore, the company should accept the offer of paying early. They will be better off by $2,000 per year. So guys, there we go. Standard type of question you'll see in FM. And we made quick work of it. Notice we've got a standard template, costs, benefits. We do easy things first, and then we have this standard working, the difference in inventory or receivables or payables multiplied by the overdraft to get the solution there. So guys, I'm liking it. Full marks earned here on part A. Moving on to the next one. This one's about EOQ. And now this one's going to be a bit trickier, and this requires us to remember a formula, the total cost of inventory. So any one of these EOQ questions is going to be based on this working. We need to know our annual holding costs, our annual ordering costs, then our annual purchases. Okay? All of these questions work off of this. And if we can just recap the formula. Let me think. Which one is about the deliveries? Ordering cost is about deliveries. So that's about the number of deliveries times the delivery cost. So that's going to be the demand, how many units we need in 1 year, divided by the order quantity. So if I need 100 things and I order them in boxes of 10, I need to order 10 boxes, right? So that's the number of orders multiplied by cost of placing an order. Now, once I have that in place, I visualize. The other one is just going to be Q over 2, right? The average inventory multiplied by CH. Annual purchases is going to be demand times the price, right? If I use 1,000 units a year, each unit costs $10, then I'm paying $10,000 a year. So I've got my annual cost of inventory formula set up. And now I'm going to put one line for each item in the equation. So I need a quantity. I need a CH. I need a CO. I need a demand. Okay. Maybe I need a price as well. Now that that is set up, let us read the story. I like to set up my templates before I read the story. We know if it's an EOQ kind of question, the answer always lay in that setup. So we purchase 2.4 million per year, annual purchases, 2.4 million per year. Hard to read. Let's set that now to this. Okay, we've got that correct. Annual purchases at a price of $5 per unit. Let's put the price here. Guys, we can get demand then, right? We could divide the annual purchases by the price that we pay. That's how many we buy a year. Each component, the company orders components at the start of the month. So they do 12 orders per year currently. So the quantity would be equal to this one divided by 12. If we do one order per month, then we're ordering 40,000 per month. The holding cost is 1.06 per year. And the ordering cost is 248.44. That's great. Let's put these items to the cents because that's what they gave us. Now, what do they want us to do? Evaluate if they should switch to EOQ. Okay. So, if we switch to EOQ, let's first get the total cost of inventory under the current situation. And that's going to be equal to Q divided by 2 multiplied by CH. I'm using the formula. Okay, there we go. If we did this correctly, well, not yet. And then demand divided by Q, that's going to work back to 12, isn't it? Because that's how we got that, multiplied by the cost of placing one order. There we go. Total cost of inventory equals the sum. You might be confused because the model answer didn't do purchases, but I'll address that in a minute. Okay? So the total cost of inventory is here. If we switch to EOQ, we can do a little side working down here maybe. EOQ is equal to what? 2 times CO times D, 2 COD over CH, right? And then we do that to the square root, 1/2 or 0.5, whatever you want to do there, right? That's the EOQ formula. So now, let's just do it right here. Equals, open a bracket, 2 multiplied by CO times demand divided by CH, close the bracket, to the power of 1 over 2. Or you could use that square root function, whatever you prefer, and we got 15,000. EOQ. Okay, so now let's do this. Equals EOQ. Now that we have EOQ in place, it's just a matter of bringing in those variables and letting the formula do the work for us. So that's equal to this, isn't it? This one also equal to that. Demand didn't change. The price didn't change. So the only variable that changed in our setup is the quantity. So if I drag all of this over, it should nice and neatly recalculate everything for me. And it did. Look at that. Look at that. We know we're at EOQ when those are the same. We want it to stay at that. The spreadsheet thought it was being helpful and offered to add a number for us there. Okay. So now we can do a difference. And that's equal to this one, or this one minus this one. Okay, 8281. Okay. So do we have a savings? Yes, we do. To that, we have a savings of 8281. So we should switch to EOQ for ordering. There we go. We've got the full 6 marks. Now, why did I do these purchases? Because usually, or if not usually, often they give you the question, calculate EOQ, and then the supplier offers to give you a discount if you order in a bigger quantity. So if they said you're going to get a discount if you order in a larger quantity, then we would lower the price, wouldn't we? We'd lower the price to reflect the discount, and that variable would also adjust. But because the annual purchases didn't change, we don't even need it. But it's there, so we can leave it there. It's fine. So ladies and gentlemen, there you have it, EOQ. Hopefully you were able to make quick work of this question on your own. Ladies and gentlemen, moving on to part C. Now we've got some theory. So what I do, I recall my book knowledge. If we want to improve trade receivables, we could analyze credit more effectively. We could collect more effectively, or we could go to a factor. But guys, I got 3 things, but 10 marks. So now I think more. To analyze credit, what could I do? I could say you need a reference from your bank, or we could go to an agency, okay, or you can bring financial statements. Okay, those are 3 things we could do there. For efficient collections, what could we do? Well, let's make sure that we monitor amounts owed. And then we can have a standard process. And we can have escalation to scare them. Okay. Factoring, we could have 2 types of factoring. We could do recourse or recourse. So guys, this is an important part of answering the question, is setting up a structure. I see that I have 10 marks, so I'm looking for 10 things to say. Okay, so now let me pause the video, let me write up my answer, and then I'll share it with you again. So I've spent 10 minutes or so writing up my answer, and I'm using a much simpler, more direct, more efficient writing style than we see in the model answers. Have a look at what I've written. We can improve checking our customers' credit rating to avoid bad debts. We can do the following. We can ask our customers to get a reference from their bank. This can prove they are in good standing. Agency. We can use the services of a third party to score the potential customer for us, saving us time and providing more skill. Financial statements. We can check their published financial statements to see if they have been maintaining good credit and have been profitable. Many countries have this info available online. Notice my structure. Every point that I make, I'm trying to separate it with a heading. I'm writing in concise blocks of text. It's going to help the examiner and the markers mark our script. Avoid those big, dense paragraphs that you see in the answers in the book. So guys, that's what I did for the first 3 marks. Now, you can pause the video here and see what I wrote for the final parts. Let me finish the underlining. Okay, team, so there you go. Pause the video and you can have a read of what I've written. You can see that I'm using the same approach. So what do we have here? Do we have 8 marks, 10 marks? I can't tell you that exactly, but I'm sure we have a comfortable pass. Moving on to the next question, question Hebak. Boy, I'm so happy. We've got NPV. It's one of my favorite things to do in an FM exam. I've practiced it. It's a pretty standardized type of question. So we can just rock a template before we read anything because we know that these type of question always follows a standard approach. We can do year. 0, 1, 2, 3, 4. Then we can do unit level things. We could do, well, first we'll do a demand. Then we can do a price. Then we can do a variable cost per unit. Guys, this is a standard template that we've practiced many times, okay? So that's the first step. Set up the unit level business. So with this, we can then move quickly to our cash flows. Okay. Now, with this, we can do sales, total variable cost, total fixed cost if they give it to us in the story. Then we could do what? Taxable cash flows. So people, every question we've ever done together has this kind of a layout. Then there are essentially 3 complications that we'll find below. So let's just skip a couple of lines. Then we can do initial investment. Okay. And then we can do net cash flow. Guys, always start with a template. If we find a little something, we can always tweak it, but it's good to know what we're going for. So guys, we read the story. We learn about some marketing costs that they already spent. Guys, the classic sunk cost trap. So we don't care about those 500,000 of market costs. But here, we do care about this. 0, 200, 800, 900, 400, right? So we put the demand in, just copying from here. Does it even copy paste in? Wouldn't that be crazy if that worked? Didn't work. So we just type it in, 15, 18, 22, 22. Variable cost per unit is 9 every year. Okay. So we got our unit level business in place. Now, I'm sure there's inflation. And what do we got? Selling price, inflation are 4% for the sales. Variable cost is at 5%. Okay, 5% inflation. Now fixed costs are 500,000 per year, negative 500, and those are going up at what? 8% per year. Okay, so we're setting everything up, and then we can get a taxable cash flow line there. And do we have an initial investment? We do, 2.5 million. So that would be in year 0, wouldn't it? Negative 2500, like that. Negative initial investment. Cease at the end of 4 years. We're going to sell everything for 125 when we're all done. Ooh. Now, what else do we need? We need some working capital. So let's put a line here for working capital. Let's do that later. Let's do the basics first. Then we can come back and mess around with the difficult things. Maybe I'll put that here. We always have tax, don't we? And we usually also have the tax allowable depreciation, which is right there. So guys, you must be able to crank out a template very quickly, just like I did. We do the years, we do some standard rows at the top, we do some standard taxable cash flow business here. The bottom is always the same. It's this part that can be a little bit different occasionally. Okay. So with this in place, we can start rocking. Sales will simply be equal to 200,000 units multiplied by a selling price of 15. But we've got to account for inflation multiplied by 1.04. And then we do to the power of the number of years there to show the compounding of the inflation, because the inflation builds 1 year after the other. Okay, if I hit return, there we go. Now, people, I forgot about one thing. It says here current price terms. So that's the clue that the inflation starts in 1 year. Now, drag this over here. And that's looking good. Variable costs, same thing, will be equal to the demand multiplied by the variable cost multiplied by 1.05, right? That shows inflation multiplied by, not multiplied by, to the power of the year. Okay, right there. So that's my formula for variable cost. And I can hit return, and I like that. Now we can drag this over here. Looking good. Guys, in the books they like to give you contribution, but there's no mark for contribution. Doesn't help me in this case, so I'm going to skip it. Okay, so this is coming together nicely. Now, fixed costs are 500 a year, growing at 8%. So that's simply going to be equal to 500 multiplied by 1.08 to the power again of the number, the year number, to do the compounding for me. 540. There we go. Guys, making quick work of this. Let me provide a little now standardized formatting so it's just neat and easy to read. There we go. So look at that. Step 1, let's make our years. Step 2, let's make a standard template with our rows. Every question essentially looks like this or very close. So now the first calculation, well, not the first calculation, but the next important piece of the puzzle is this, sum. Let us get to this. We got 690. And if I drag that, there we go, looking awesome. So team, we have a rocking answer in progress here. It looks so good. Alrighty team, we're doing great. Now, let's find that tax line. What do they tell us about tax? 20% tax, same year that the cash flow arises. If it was arrears, we'd offset it by 1. So we take the tax and we multiply this by negative 0.2, 20% tax. Okay, now let's take care of the tax allowable depreciation working. What do they tell us about that? We can claim tax allowable depreciation 25% reducing balance adjusted in the final year of operation with a balancing allowance. So we've done this on our course. Let's do this. Let's grab the years. We're going to need these. Do a working over here. And we need the written down value of our asset. In year 0, we're going to buy the thing for 2500. Okay? And they tell us that the tax allowable depreciation, 25% reducing balance. So you should remember reducing balance depreciation from your other papers. All we need to do is grab the opening balance multiplied by 0.25, right? And that is the 25% depreciation. Reducing balance means we get a net book value now, or a written down value, equal to that one minus this one, right? That's what's left over after we've taken the depreciation chunk out of it. So guys, now we just drag this one over, and that took 25% of this. That one comes over, and that's the difference now that we've taken that 468 off of there. And so on. So that's how it works, and all you got to do is this, and there we go. Reducing balance depreciation. Now people, we got one more thing to do here. This is the trick. The total of all the depreciation needs to equal the cost of the asset minus the scrap value, because at the end of the 4th year, our asset is completely depreciated. So in the end of the 4th year, the total depreciation needs to be equal to the 25,000, 2,000, the 2,500,000 that we paid, minus that residual value of 125, right? So the total depreciation needs to be equal to that. So guys, now in the last year, this is my total depreciation to this point. But if I add that up, it does not equal this. It's less than that. So I'm going to do this. Equals the total minus the sum of these. Okay, 929. So to recap, every year we have our reducing balance depreciation. But in the last year, we get a balancing figure that needs to bring the total depreciation to 2375. I can do an equal, I can do a sum. I can grab this. And look, it worked. That's a little test. So we did it very correctly. Now, we got the tax allowable depreciation, but the cash flow implication is the tax savings, right? The tax allowable depreciation reduces my tax bill by what percent? By 20%. So that will be equal to this one multiplied by 0.2. There we go. So guys, that's our standard tax allowable depreciation working. Okay? And that comes up in almost every one of these type of questions. So we come back over here. Tax allowable depreciation. Let's use the magic of the spreadsheet. Just grab that figure there. 125. We've got those figures in. Now guys, if you didn't know what to do at this point, you would be totally fine. You've got enough marks to pass. Last thing to do is our working capital investment. And let's do that as a working again. I'm going to grab this. So guys, they tell us for working capital, we need an investment of negative 1,500, right? So we got to put 150,000, 1,500,000 into the business to pay for inventory, for some cash, so we can kick off the business. Now, what's going to happen is this. Every year, we get the recovery of that at the end of the year, okay? So we put in 1,500, we get out 1,500. But then the requirement is growing by 6% per year. That means we recover the 1,500 at the end of the first year, but we got to put in a little bit more because of inflation. We got to put in, they said it's going to grow by 6%, by 0.6%, not 60%, 0.06, okay? So we got a 90. So now for year 2, this is going to go up by 6% times 1.06. Okay? And that inflation is going to keep happening. Okay? Until we now recover everything. So at the end of year 4, the project is over and we're going to get all of the working capital back. So that's going to be equal to the sum of all of this, but we make it negative in front. Look at that. Okay. So I got the sum. Wait, my formula is broken. Let me start that over. Equals the sum of all of this. But it should be negative Okay, and if we did that correctly, the net working capital should be 0. This one plus this one plus this one plus this one plus this one, 0. So guys, our working capital investment is correct. So now I can bring those numbers into this line, working capital equals that negative 1,500. I put that in the wrong place. Equals the 1,500 there. Drag that over. And it's good. Guys, it's not good, it's great. Now, let's just unify everything with the same rounding off, with the same precision. Don't need decimal places for this. There we go. Guys, we're almost done. Now that we've got our cash flows, we can do a net cash flow. That's going to be equal to the sum of all of this. The taxable cash flow down to initial investment. I don't want to go all the way up or I'd be double counting. And that didn't work. Let's try it again. Equals the sum of taxable cash flow to initial investment. That worked. Okay. Now, if I drag this over, I have my net cash flows for each line. Okay. And looking good. So I can grab this and I can make it bold. So people, that's a very important milestone in our work, getting a net cash flow line. Now, let's have some fun. Let's do the NPV with the formula. On our course, we did it so many times with the discount factors. Let's do it the cool way. So what we need is this. We need the present value of years of cash flow, year 1, 2, 4, right? So guys, I'm going to let the software do the discounting. I'm going to go equals NPV, right? That's the function you need to know. Now we need a discount rate, and they give me an after-tax discount rate of 12%. Right there, we want the 12. We have inflation, so we use nominal. With inflation, we use nominal. Ignoring inflation, we use real. So I put 0.12, comma, grab these cash flows. There you go. So the first argument is the discount rate. Second argument, the range with the cash flows. I get 15980. Now we can do year 1, year 0, and we can just grab that from here. Year 0, right? That doesn't get any discounting. And then NPV will be the difference, equals the sum of these. And guys, it looks awesome. There it is. So let's not forget the easy thing to do here. NPV is positive. The project will increase owner wealth, so we should accept. Ladies and gentlemen, that was a net present value workout extraordinaire. Make sure you can do this. Do it again. Do it a second time. Make sure you can do this question, in 5 or 6 minutes, just blazing fast, accurately. If you can do this one, guys, you can do, any one in the book, just about. Don't sweat the little details. If you weren't sure about one little thing, just try something and keep it moving because you get partial credit. They don't mark you for the final answer. They mark you row by row. Did you use the right approach? So guys, there we have it, part A. What fun we had. Let's now move to part B, and we have, like usual, a theoretical knowledge dump. Discuss how CAPM can assist in making a better investment decision to its new product launch. So guys, let me think about that. 8 marks. Not sure if I know 8 things to say. I'm going to try and say 6 things. So guys, let me pause the video. Let me write up my answer. Hello team, welcome back. I've written up my answer and I'm using some more information from the story. We discovered that ABAC is launching their new product in a new market outside of its current business operations. This means that their current cost of equity does not reflect the new business risk that the new product will be incurring in this new market. So we need to adjust the equity beta of ABAC, right, to adjust it for the difference in risk. And guys, I'm just going to explain in plain English how we use the asset beta formula. And I'll read you a little bit of it, then you can pause and you can read the rest. The new project is in a new market. This means there is different business risk. The current weighted average cost of capital is based on the current business risk, so not applicable to the new project. Mark is earned. With cap M, we can estimate a specific cost of equity using the following steps. We can find a company that's operating in the new market. We'll call this the proxy and assume that its shareholders accept the business risk of the new market. We can get this company's equity beta from the stock market news, assuming it's listed. That's step 2. Then we can use the asset beta model to de-gear it. This means removing the financial risk. Okay? So guys, you can pause the rest of this and read this. You don't need me to read it out loud for you. So pause the video. Team, there you go. Is it 8 marks? Don't know. The marking happens in a black box. We don't know the actual way the marking happens, but I answered the question. I'm confident I've got a comfortable pass here. Is it 6 marks? 7 marks? Will I get a mark for this first sentence? But I know it's a pass. So ladies and gentlemen, there you go. That's a wrap on the second section C question. And I hope you found this debrief video useful. This is Steve signing out, saying good luck on your upcoming FM exam.